The high-yield dividend income game just got a lot more interesting, and two bold dividend ETFs are shaking things up. CHPY is zeroing in on the booming semiconductor sector, riding the wave of giants like NVIDIA and TSMC. Meanwhile, ULTY is turning up the heat with an ultra-aggressive option strategy targeting volatile growth stocks. Both have been delivering eye-popping payouts, but the real question is, are these sustainable income machines or risky plays ready to blow up? In this video, we'll dig deep into the numbers, break down the strategies, the potential rewards, and the risks, so you can decide whether to buy, hold, or steer clear. And if you want more high-yield ideas, stick around. I'll share a couple of other income plays that might fly under your radar, but have strong potential. Before we jump in, remember, this is not a financial advice. Always do your own research before making investment decisions, and if you find this video valuable, like, share, and subscribe so you don't miss the next big opportunity. All right, are CHPY and ULTY the high-yield dividend powerhouses your portfolio needs? Let's dive in. YieldMax Semiconductor Portfolio Option Income ETF ticker symbol CHPY. Launched in April 2025, the company offers a unique proposition for investors looking to combine steady, high-frequency cash flow with exposure to one of the most critical and fast-growing sectors of the global economy. Semiconductors. This isn't just another passive index tracker. CHPY takes an active approach, blending income generation and growth exposure in a way that stands out from the crowded ETF landscape. At its core, CHPY invests in a concentrated basket of 1530 U.S.-listed semiconductor stocks, focusing on companies with the liquidity and scale to support its strategy. The top 10 holdings, which account for roughly 62% of the total portfolio, are an impressive lineup of industry leaders such as Broadcom, NVIDIA, TSMC, Qualcomm, Lam Research, and Texas Instruments. These are the companies that design the chips, manufacture them at scale, and produce the advanced equipment that powers AI, cloud computing, autonomous vehicles, and next-generation consumer electronics. In other words, CHPY gives you direct ownership in the businesses driving the world's digital transformation. But where CHPY truly differentiates itself is in its income generation model. Rather than relying solely on dividends, the fund deploys aggressive options-based strategies, including covered calls, credit spreads, and collars to generate significant weekly income. This means investors aren't just waiting for quarterly or annual payouts. Instead, they can expect cash distributions hitting their account every week. In a market where many income-focused ETFs are struggling to offer anything above a mid-single-digit yield, CHPY's headline numbers are nothing short of attention-grabbing. The data backs that up. CHPY's latest annualized distribution rate sits at a staggering 40.4%, while its trailing 12-month yield comes in at about 12.5%, a gap explained by the ETF's short operating history and its recent ramp-up in income payouts. Since inception, it has delivered a total return of roughly 20.7%, outperforming the S&P 500 in the same period. YieldMax CHPY. Weekly distributions have ranged from 0.345 cent to 0.622 cent per share, providing a level of frequency and consistency that income-seeking investors rarely find. Since its April 2025 debut, CHPY has traded between $40 and $56, trending upward since late June on rising volume. It currently trades above its 20- and 50-day SMAs, with a short-term golden cross in July signaling bullish momentum. RSI sits around 62.65, showing strength but still below overbought levels. Support is near $53, with stronger support at $49. Resistance is at $55, and a breakout could target $60 and above. Weekly distributions often cause brief post-payout dips, creating short-term entry points. Chartmill rates it 0.3 for technical strength, lagging the broader market, but still in an uptrend, while Financial gives a buy rating with price above its 200-day average. Bottom line, technically, CHPY leans bullish with room to run, but the small fund size and options-driven structure call for disciplined entries and close monitoring. Of course, high reward often comes with high risk, and CHPY is no exception. Its 0.99% expense ratio is well above the average for ETFs, reflecting the costs of active management and complex options trading. The fund's assets under management, AUM, currently hover in the $30 to $32 million range, which places it firmly in the early adopter phase. Lower AUM can mean lower liquidity, potentially resulting in wider bid-ask spreads for investors who need to enter or exit positions quickly. Another point worth careful consideration is the composition of CHPY's payouts. Around 84% of recent distributions have been classified as return of capital, ROC, rather than income from dividends or gains. While ROC isn't inherently bad, it can offer tax advantages. It also means that a portion of what you're receiving is simply your own invested capital being returned to you. Over time, if this pattern continues without corresponding NAV growth, the fund's value could gradually erode. Layer in the inherent volatility of the semiconductor sector, a space that can see sharp price swings due to global supply chain disruptions, changes in chip demand, or macroeconomic shifts, and you have a fund that is both an exciting opportunity and a potential roller coaster. The combination of sector cyclicality and leveraged option strategies makes CHPY a product best suited for investors who not only understand the risks but can stomach the fluctuations that come with chasing ultra-high yields. The next high-yield dividend ETF is YieldMax Ultra Option Income Strategy ETF ticker symbol ULTY, launched on February 28, 2024, and has quickly carved out a niche as a high-income, weekly paying ETF, though one that comes wrapped in a complex strategy and cautionary fine print. ULTY isn't a standard dividend fund. Instead, it's an actively managed ETF that uses covered call strategies on a rotating basket of 1530 U.S.-listed equities, primarily high-volatility, growth-oriented stocks, to generate consistent weekly income. With a net expense ratio of 1.30% steep by ETF standards, but expected given the active, options-heavy structure, ULTY now manages more than $3 billion in assets and trades on NVIDIA Arca. Its rated yield grabs attention, clocking in at over 116%, annualized based on the trailing 12-month figure of $7.82 in distributions. Its distribution rate is even more eyebrow-raising at 86.93%, suggesting miners a very high yield. That said, over 40% of the most recent distribution was classified as return of capital, which could mask erosion of NAV. Performance-wise, ULTY has delivered strong upside. Year-to-date market returns are about 15.8%, and month-to-month gains have swung as high as 29.9%. While that outpaces the S&P 500, note that the upside from underlying equity performance is capped due to the covered call overlay, meaning if stocks soar, ULTY's gains are limited. And yet, the fund isn't protected from stock downside, so its volatility can be twofold, from equity prices and from options. Its holdings reflect its high-risk speculative nature. The top 10, accounting for roughly 54% of the portfolio, include names like Coinbase, 4.1%, Rigetti, Bitmine Immersion, AST SpaceMobile, AppLovin, IonQ, Upstart, and others that many would classify as moonshot tech plays, rather than stable income generators. On the technical side, modern indicators offer a mixed picture. On TradingView, the one-week technical rating shows a sell signal, while the one-month view flips to buy, signaling short-term caution but potential longer-term opportunity. TradingView. On Financial, some EMAs show buy signals, for example, 8-day and 20-day EMA, while SMAs lean sell, especially on longer timeframes. MACD reads buy, and RSI is low, near the oversold zone at 39, which could hint at a bounce. That all leads to a compelling but deeply controversial value proposition. Weekly income and huge headline yields, all from speculative growth stocks and options premiums. So here's the big question. Would you trust a fund yielding over 100% if a hefty chunk is unpackaged return of capital? How much volatility, both market and strategy-driven, are you comfortable managing for that kind of payout? And do weekly payers give you confidence or pause compared to monthly income alternatives? ULTY is the embodiment of high-risk, high-reward income investing. It may appeal to traders chasing explosive short-term yield, but as a long-term foundational income tool, it demands skepticism and a close eye. Let me know your take in the comment section. Remember, this is not a financial advice. Always do your own research before making investment decisions. And if you find this video valuable, like, share, and subscribe so you don't miss the next big opportunity. See you in the next video.